Hi friends, so let us understand what is BEPS, what is Pillar 2, Pillar 1. So BEPS, OECD has already adopted base erosion profit shifting 1.0 in this 15 action plan, equalization levy for digital payments and many things has already implemented such as arm's length pricing, permanent establishment. So now they are looking to change entire gamut. They are thinking Pillar 2, ग्लोबल एंटी बेस इरोजन थ्रू ग्लोबल मिनिमम टैक्स. आप पे, आपकी कंपनी पे अगर वो एमएनई है, मल्टीनेशनल इंटरप्राइजेस है, तो 15% का मिनिमम टैक्स तो देना ही दो. आपका एक एंटरप्रेन्योर है दुबई में, यूएई में, वहाँ पर उसका 9% सपोज कॉर्पोरेट टैक्स एज इट लेबीड, बट वो चाहते हैं कि 15% तो टैक्स लगे. आप एक यूएई में ऑपरेट कर रहे हैं डिवीज़न, वहाँ पर 10% टैक्स लगता है, तो 5% हो सकता है आपको इंडिया में अल्टीमेट पेरेंट कंपनी को देना पड़े. तो OECD इज थिंकिंग मिनिमम 5%, मिनिमम 15% टैक्स इज नीड टू बी चार्ज. So on that basis 137 out of 141 members has already been agreed, signed this Pillar 2. So what is preamble? Globi rule provide a coordinated system of taxation. सारी कंट्रियों को एक कोऑर्डिनेशन करना होगा. भैया आपका 10% है, यहाँ का 15 तो लगाना है, तो आप 5% चार्ज कर लो, हम अपने डोमेस्टिक लेवल पे नहीं चार्ज कर रहे हैं. तो बेसिकली इट्स इम्पोज मिनिमम लेवल ऑफ टैक्स ऑन द इनकम अराइजिंग jurisdictional basis. We have to judge on jurisdictional blending basis. It does so by imposing top-up tax. So top-up tax need to be imposed whenever the effective tax rate determined on the jurisdictional particular country basis is below the 15%. सो जो डिफरेंस है वो टॉप अप टैक्स लगेगा. सो बेसिकली हार्ट्सबर्ग दिस ग्लोबी रूल, फर्स्ट ऑफ ऑल इट्स इम्पोज डोमेस्टिक मिनिमम टैक्स. सपोज आपके यहाँ जैसे मैट है ना इंडिया में 15%, ऐसे ही ये कहते हैं कि वर्ल्ड में भी भैया हमें 15% तो टैक्स लगाना है हर कंट्री को. तो या तो खुद लगा लो आप लो टैक्स ज्यूरिसडिक्शन जो है, या नहीं तो आपकी अल्टीमेट पेरेंट कंपनी इनकम इंक्लूजन रूल के थ्रू लगाएगी. ठीक है, आपने दुबई में 10% लगाया, 9% लगाया, तो 6% इंडिया की कंपनी लगा लेगी. अगर ये नहीं लगाती तो अंडर टैक्स पेमेंट यूटीपीआर, जो अदर सब्सिडरी है उनको यूटीपीआर लगाना है. तो दिस इज द फ्रेमवर्क दे आर थिंकिंग. एमएलआई 1.0 ऑलरेडी सक्सेस. OECD now thinking revise multilateral instrument by imposing subject to tax. So this is the next year plan 2024 they will implement. First of all, in 2022 itself they have to sign, make a law. Already OECD release example, commentary, everything is on place in blue book, how it's work and how it will be implemented. So as I said, it's applied to multinational enterprises. Suppose your entire group in India, so it does not make sense. It is not a multinational enterprises. If you have a country in ultimate parent entity in India and another subsidiary in UAE, so it's a multinational group. So MNE group, it's also defined. So when it is applicable when your revenue threshold. We have to see your consolidated financial statement, whether any two of preceding 4 year, it's your revenue is more than $750 million, approx 6,400 INR. So in that case you are triggered. So this is the skeletal view. We have to see jurisdictional blending basis. Suppose all three entity in UAE, we are in India, so we have to compute together all the profit. 2,000 profit and 4,000 profit, 5,000 loss, so 1,000, it's jurisdictional blending. So let's suppose you have one subsidiary in UAE and another subsidiary in Baramulla and some other countries. So ultimate parent entity will see in particular this jurisdiction whether they are paying tax, minimum level of tax. If not, then 15% will be applicable. So what is the pre-global rule? Says ultimate parent company is paying 30% here and 20% in country A, B and C is nil. So after the global rule, this profit, 4,000 profit, will tax 15% additional. So this is the impact. Our tax is raised from 700 to 1,300. Since the global ETR 15% does not foresee global rule. So now we have to see there are some minimized exclusion is also there. If suppose in particular jurisdiction your profit turnover is less than 10 million euro, so that is excluded from the purview of global rule. Some country has provided enjoy income linked incentive, so that is also out of the purview of this global rule. As in India there is a 200% depreciation, additional depreciation is there. This is the incentive scheme. So most of the countries is providing this kind of this because your depreciation will charge to defer tax. So they have to compute ETR based on current tax as well as defer tax. So your defer tax is need to be computed in that scenario, also computed for this purpose also. Netherlands, suppose in our example, 1,000 is gross income and 600 is net income. So 10% is withholding tax is deducted. So in this situation already 15% ETR is met. So there is no question of IRR. So in case of Bangladesh, they are providing investment linked tax incentive. So we have to charge defer tax liability. In that scenario, no IRR. So Brazil, suppose we are given this example is very good example. First year our is loss. Most of the companies first year for startup they have made a loss, and second year they made a 6,000 profit. So we need to compute what is the tax liability for this second year. First year they have computed defer tax asset on this 5,000 loss, right? On the next year they will have to reverse this defer tax. So 750 is defer tax and 150 is current tax on this after set off of brought forward losses. 900 is comes to, that is met the 15% ETR, so no IRR. So in another case of Marshall Island, they are operating some charter vessel, so this some sectoral exclusion is also there. So this is the out of scope. So Cayman Island, no tax, ETR is nil, so IRR pickup. So this Cayman Island, Mauritius, Malaysia, they will at present is low tax jurisdiction. Everyone in the world is raised to bottom कि भाई हम कम से कम टैक्स लगाएं, हम कम से कम टैक्स लगाएं. सो वहाँ पर गवर्नमेंट ये सपोर्ट कर रही है कि यहाँ आइए और बिजनेस लगाइए, हम आप पे टैक्स नहीं लगाएंगे. बट नाउ एवरीथिंग इज गोइंग टू चेंज. 15% तो मिनिमम लगेगा. मॉरिशियस की टीटी के अकॉर्डिंगली 3% ETR बनता है तो 12% IRR पिकअप हो जाएगा. फ्रांस है, वहाँ पर ETR नील है. अर्न इनकम फ्रॉम ओवरसीज जुरिडिक्शन विच इज टैक्स हेवन कंट्री है तो IRR पिकअप हो जाएगा. होल्डिंग कंपनी अर्न डिविडेंड कैपिटल गेन दैट इज एक्सक्लूडेड बिकॉज इफ यू आर पोर्टफोलियो इन्वेस्टर less than 10% your investment will be excluded for the purpose of dividend and capital gain. So this is the gamut of Global rule. So now we have to see top-up approach. So this Dubai company is low tax jurisdiction, enjoy ETR is nil, but ultimate parent entity is adopted Global rule. So this has to bear the tax liability on this profit. Suppose 10,000 is top-up tax of D company, D country, so 15% of 10,000 has to bear by the ultimate parent entity in country A. So how it's look like in case of partly owned parent entity? So Global rule OECD commentary says that if your investment in particular jurisdiction is more than 20%, in that scenario we will not pick up this ultimate parent entity. This partly owned parent entity has to bear this IRR in respect of this low tax jurisdiction tax liability. They don't want to pick up this. Suppose 10,000 of top-up tax, top-up profit on this D company. We trigger ultimate parent entity for this situation. In that scenario, only 75% of tax is levied. But if we trigger this, as per the commentary, this is the good scenario for IIR pickup. So in case of, as I given 20% example, this partly owned parent entity should be the bear the tax liability of this company. But in case of less than 20% ownership intermediate parent entity, then it says only ultimate parent entity will bear the tax impact. So how it's compute top-up tax? So we need to compute net global income, adjusted cover tax. Adjusted cover tax divided by the net global income. What is your jurisdictional ETR? If your jurisdictional ETR is less than 15%, the difference 15% minus jurisdictional ETR, your additional tax liability. Top-up tax is 15% minus jurisdictional ETR. This is the tax liability you need to bear. Excess profit, obviously, suppose in Dubai you are earning 4,000 crore profit, but based on employment is there, based on asset located there, they have used some substance based income exclusion. So 10% of payroll cost, 8% of average of tangible asset need to be excluded for that. This top-up tax will apply on the excess profit only. So jurisdictional TUT will be TUT जो भी हमारा 5% आया, that applied on excess profit only. So recoverable TUT is either Dubai will levy domestic minimum top-up tax or India will levy IIR. If India will also not adopt the global rule, then the subsidiary will recover the under tax payment. So this is a scenario in case of partly owned entity. 80% is owned by ultimate parent entity and 50% owned by this. So 1,000, 4,000 payroll cost and ETR for this company is nil. So let us see what will be impact. So this 1,000 we have to bear 25% tax rate in particular jurisdiction, and 4,000 there is a no tax. So our effective cover tax is 250. 250 by 5,000 is 5%. It's a jurisdictional tax. So top-up tax is 15% minus 5%, it's 10%. So now we have to compute the excess profit. 5,000 minus the substance-based exclusion is there. 10% of payroll cost and 8% of tangible asset. So 5,000 minus 2,000, it's 3,000 is our excess profit. So this excess profit we need to apply top-up tax 10%. So top-up tax come to 300. So now this 300 need to be recovered either by the domestic tax levy by the particular low tax jurisdiction, or if not levy, ultimate parent entity levy income inclusion rule. Otherwise UTPR is there. So this 300 we need to recover in the proportionate global income. So suppose this 300 top up tax in respect of this A2 jurisdiction not levied by the domestic company, then it will be recovered through the UTPR. This also not recovered, IIR also not applied, but UTPR has to be applied in between this company. A and B, A1, A2 will recover 300. In their global income proportion, also percentage holding of this company. So 170 out of 300 is recovered in this situation. Remaining 130 is under tax payment is need to be recovered. So this scenario is another thing where the top up tax in this particular low tax jurisdiction is 600. Now we have to compute proportionate on the basis of number of employee, tangible asset. So 600 380 is to 220 UTPR top up tax need to be recovered. So let us make another challenge. What is impact, IIR impact? So Mauritius company, you have Mauritius entity is there, but Mauritius company is declaring a dividend, paying nothing tax in Mauritius entity. This dividend goes to Indian company goes to distributed dividend to the shareholder. So global rule not applied to the individual, but Indian company has to pay tax on their stand-alone financial statement on the dividend from Mauritius foreign dividend. So this 34% pay by this I company. So in that scenario already 15% criteria is met. So no question of global rule, pillar 2. But in case this Indian company is taken advantage of ATM deduction, this dividend declare, they have already claimed deduction ATM, so nothing is paid. So now it top up tax question is arise 15%. So another is example, high tax jurisdiction given a dividend to the low tax jurisdiction and low tax jurisdiction given to the ultimate parent entity. In that scenario also top up tax is applicable, because this impact of tax liability go to this level, but here we are paying nothing, zero tax, so not go to this level. So how the STTR subject to tax rule is there? So suppose we are making a foreign remittance to UAE, and UAE is a market nexus. So UAE government has adopted the corporate tax, that is 9%. So STTR will be recover 9%. We are also making another payment to Mauritius for the purpose of CCD debt interest. So on that basis, as per the TT 11(2) article says that 7.5% is tax liability is there, but they restrict the foreign tax credit. So in that scenario, 1.5% short payment for STTR is levied. This is the STTR is the second concept. First of all, government will levy global rule. After that, next level, they will levy STTR through the multilateral instrument changes. So interest payment to UAE is we are paying under section 194 LC, that is outside from the purview of 195. So 4% is also STTR is there. Another payment to Netherlands entity which is headline rate is 25%, so no impact of STTR. So basically, so government OECD is thinking that we levy minimum tax. Most of the companies using arm length change the transfer pricing in such a way so they can enjoy the benefit. They enjoy benefit for particular low tax jurisdiction. Suppose Indian Nissan company, foreign Nissan company, they make a particular car in India, but pricing do in such a way the tax liability in this jurisdiction is lower, but they enjoy the benefit of tax haven countries tax structure. So they need to work out the arm length in that scenario also. OECD also says that once you adopted the global rule, then whatever the you levied BEPS 1 action plan equalization levy, you need to withdraw that also. What is the equalization levy? India has adopted the equalization levy 1.0, that is 6% on advertisement. Suppose you are paying advertisement cost to the Facebook, you have your expenditure is more than 1 lakh, then you need to charge 6% equalization levy from the Facebook. It's like TDS. So you need to charge, Facebook will bill to you 1,06,000 and 6,000 you need to pay as equalization levy. In EL 2.0 they have already implemented levy equalization levy in respect of goods sale by the Amazon. There is a 2% tax rate is there. So if the Amazon is selling in India, e-commerce entity selling more than 2 crore, then the 2% equalization levy Amazon has to pay. We don't need to charge TDS. So this is the such kind of thing. So what is going on? OECD strengthen the transfer pricing mechanism. They develop P concept. POEM is already there. If you are located in particular this jurisdiction, everything is governed by the another jurisdiction, decision making by the directors outside India. So all those profit is also be taxed in this particular jurisdiction, so through the POEM concept. So on this scenario, we are still clear. OECD want to levy minimum 15% tax. They want to stop race to bottom. No need to tax all those Cayman Island, Marshall Island. They are enjoying the tax at present through the TT or without the TT through various kind of incentive linking schemes. So now they have to 15%. So we will see Shah Rukh Khan, all those stars are paying high tax in India. They are awarded by the income tax department. So we will see all multinational entity has the umbrella in India, but they are managing through the outside countries by enjoying the low tax jurisdiction, tax haven jurisdiction. So they have to pay minimum tax of 15%. So top up tax that will be applied on excess profit only. So hope so you are some extent is clear global rule, and this BEPS pillar 2 is very difficult. If you read commentary and example is there, but the concept is really difficult. Netflix CEO says that if this pillar 2 is adopted by the OECD and implemented by the entire world, then we as a Netflix need to appoint army of accountant. So they need to appoint army of accountant because the high profile tax is there. if they ignore particular, as I give an example for a dividend, and the top up tax will be applicable. So as I said, we have to check, we have to see impact of Global rule as per the our flagship company in India. So maybe possible CBCR, so country by country reporting is also there. We have to see what is the master file says, what is the local file says, what is our transfer pricing policies says, and how we are manipulating arm length price so that our tax effective tax rate is 0. But after the impact of Global rule, this will entire gamut will be changed. So we have to see impact of this pillar 2. So thank you guys. Hope so you understand this pillar 2 in little words, but believe me, this is very difficult. Thank you.